Hey, it's Ray, CRE Broker, and I'm Ray. Today, we're talking about something I see a lot of investors get excited about: high cap rate deals. You know the ones, the numbers look great, the cash flow seems strong, and on paper, it feels like a no-brainer. But the truth is, high cap rate investments often come with hidden risks that can catch even experienced investors off guard. Cap rates are one of the first numbers people look at when evaluating a deal. And sure, they really matter. But a higher cap rate usually means a higher projected return, especially compared to lower yield properties in core markets. But here's what many people miss. A high cap rate is often a signal that there are deeper issues hiding under the surface. It might be risk, it might be poor location, or it might be deferred maintenance that's been ignored for years. So what should you really be thinking about when you see a 8, 9, or even a 10% cap rate on a deal? Let's walk through it. First up, location and demand. A lot of high cap rate deals are in what we call tertiary markets, areas with low tenant demand, limited job growth, or population decline. Sure, the purchase price is lower and on paper, the yield looks fantastic, but can you actually fill the space? Will tenants renew? Will tenants even want to move in? You can't count on a cap rate to cover up a bad location. If no one wants to rent there, your projected income quickly becomes imaginary. Next, property condition. Older buildings often have higher cap rates because they also tend to come with higher operating and capital expenses. Think HVAC replacements, roof issues, plumbing, electrical upgrades. A seller might not fully disclose how much work is needed, and if you're not careful, those maintenance costs will eat into your cash flow fast. What looked like an 8% return could become 4% or worse once reality sets in. Then there's tenant quality. Always take a close look at the leases. Are the tenants on long-term leases, or are they month to month? Are they paying below market rent? Are the leases structured as triple net, or are you covering expenses on a gross lease? A high cap rate might be hiding a weak rent roll or short lease terms that make the property harder to finance or stabilize. Market fundamentals. Also zoom out and look at the big picture. What are the market fundamentals? Are jobs being created? Is there infrastructure investment? What's the long-term growth outlook? Because if the area around your asset is stagnant or declining, it's going to be hard to generate consistent performance or exit profitably down the road. And let's not forget about hidden costs. Just because the offering memorandum says it's an 8 cap doesn't mean that's what you'll actually get. Watch out for understated property taxes, insurance increases, property management fees, and deferred maintenance reserves. Always ask for the trailing 12 months of financials and do your own underwriting. Do not rely solely on the listing broker's pro forma. Another question: what's your exit plan? If this is a tough asset to stabilize, who's going to want to buy it from you in 5 years? You might get stuck with a property that's difficult to refinance or sell unless you put in a lot of time, energy, and capital. Let me give you a real-world example. A client of mine bought a retail center within a 9 cap rate. It looked like an amazing deal at first, but 2 anchor tenants had leases expiring within 18 months. The roof needed to be replaced, and occupancy dropped from 90% to 68% in less than a year. And that 9% return, completely gone. And he had to reinvest hundreds of thousands just to get the property stabilized. So what's the takeaway? Cap rate is a starting point, not a decision maker. A high cap rate can be an opportunity, but it can also be a warning sign. You've got to do your homework, check the leases, study the market, understand the tenant mix, talk to brokers, managers, and lenders who know the area, and always underwrite conservatively. In the end, the best deals aren't always the ones with the biggest numbers. They're the ones that align with your goals, your risk tolerance, and your plan. So the next time you see a high cap rate deal, take a breath and dig deeper. Thanks so much for watching. If you got some value from this, hit like and subscribe and drop a comment below. I'd love to hear from your experience with high cap rate deals. Until next time, don't just chase yield, chase quality.